How the money works. Show me the money. So again, a really cursory overview of how the commissions work. So in final expense, really this is true of life insurance too. Commissions are determined by the premium that's based on an annual basis times the commission percentage, okay? In other words, if Mildred pays $100 a month for 12 months, that's $1,200. That's the annual premium. Does that make sense? We're on the same page? Great. To determine your earnings for first-year commissions, you then multiply it by your commission rate. So if your commission rate is 100%, you'd multiply 1,200 times 100%, and your first-year commission is $1,200. Make sense? Good. And we'll get into like, well, what's a good commission rate in a little bit. But for the sake of understanding the basics, I just want to make sure we're clear on that. Hey, if you're a newly licensed insurance agent and you're looking for a six-figure income earning opportunity without the multi-level marketing nonsense, check out my agency, the DIG Agency, by visiting daviddufour.com or click the link below. Second of all, you will be advanced that amount, a percentage of that amount up front. So you're not getting, in this example, $1,200 up front. The company advances you, which is a fancy word for a loan, more on that in a minute, typically 6 months or 9 months of the 12 months of commission. In other words, 50 to 75%, because 6 is half of 12 and 9 is 3/4 or 75% of 12. Does that make sense? So in most cases, it's 9 months. So if you sold an American Amicable policy and your commission's 100% and the premium is $1,200 in annual premium, class, how much are you ending up with? Toss it in the chat. What's your upfront commission at 100% times 75% times 1,200? I can't see your chat. I'm just going to assume you answered it right because the math's not too hard. It's $900. So your upfront cash flowing $900. But what about the back end? What about that money I didn't get, that $300 of the $1,200? You receive that if the policy's on the books in months 10, 11, and 12. So in month 10, you get 100. Month 11, you get 100. And month 12, you get 100 for a total of 1,200 up front. Or, I'm sorry, 1,200 in commissions for the first year. You got it? What about the back end renewal money? If there's renewals, then it pays monthly at that very small rate. Usually renewals on vested contracts where your commission is high are usually in the 3 to 5% range, give or take. So in other words, 5% of 1,200 is $60. You're going to get paid $5 a month in renewals, roughly, okay, in that example. But here's the thing, because I like to keep it real, this is an educational course, you need to know this stuff. You need to know about chargebacks. Do you guys know what a chargeback is? If you don't, you're gonna. A chargeback is when Mildred pays on the policy. Sometimes they don't pay at all, and then it charges back the entire amount, but usually pays for a period of time and then misses a payment and does not decide to catch the payments up, and the policy lapses. When that happens, typically depending on the company, you owe back prorated what commission or what premiums weren't collected in commission. So let's take this mathematically a little bit more clear. Mildred pays, you get paid a $900 advance on Mildred's $1,200 premium. It's an advance of 75%. You with me? Mildred pays 3 months and then lapses. How much do you owe back if it's prorated? Well, you owe back $600 of the $900 because Mildred paid 3 payments in. That covered 3 months of the actual advance that was paid. So now you owe back $600. You with me? But Dave, why don't I get to keep that money? Well, that's the thing. Your policy is collateral, okay? It's like the down payment on the thing you're buying. In this case, you're saying you're selling. You're getting advanced money. That's a loan. Historically, before there was this advanced system, you would get paid whatever your percentage rate is based off of the monthly premium that comes in. The problem with that is it's so low, it's hard to support buying leads or even support yourself. You could do business that way, and there's less advance risk to pay back, but you also lose out on a lot of cash flow. Does that make sense? So with chargebacks, you're going to pay back some portion of it, and everybody gets chargebacks, okay? The function of how much chargebacks you get is a function of what you sell, meaning a diversity of products that you can get the best combination of price and coverage for, in combination with how you sell. If you pressure Mildred to buying when she can't afford it, you're going to get charged back. Okay. So I hit that here. If a client lapses before premiums cover the advance, agent owes back the balance, which is prorated, which means you don't usually owe back the whole thing. Some carriers do. So if you pay in like 2 months, you might owe back all 9 months. We try to avoid writing those carriers as much as possible, because I think you should keep what you convince the client to pay as far as what earned commission you keep. Overselling leads to higher lapse risk and debt. And ethical selling, proper placement, and persistency management reduced exposure.